This video segment is brought to you by Credit Grid, your source for business credit knowledge. In this segment, we will explore the issues of money and credit in developing your language of business. So let's begin. Understanding money is an important part of being a good business person. Money was invented to avoid the hassle of having to trade for the things that we need. Now, with money, you simply sell what you have to sell, you take the money and buy what you want. Money also allows us to transfer our income and wealth from one type of asset into another. This is called liquidity. Money is a way also of counting the value of business revenue and costs. Let's review some economic terms. First off, the word entrepreneur. Entrepreneur is a French word that means between taker. It is one who is responsible for creating, organizing, and managing a business that takes raw material inputs, transforms them into a product, and then sells that product. Specialization is a process of our economic climate wherein people specialize in the production of a good or service because they have a comparative advantage to do so. A consumer is a person, group, or company that uses the product or service. A producer is a person, group, or company that makes the good or service. A need is something that a customer has that helps them fulfill their life. And a want is a good or service that is nice to have, but is not absolutely necessary to have. Let's talk about our economic system. First of all, let's discuss the role of price in the market system. Prices send signals and provide incentives to buyers and sellers. When supply or demand changes, market prices adjust, thus affecting those incentives to either produce or consume. For example, if competition among sellers increases, that is, there's more sellers of the same good, that tends to lower the price relative to the cost, and thus profit margins on sales tend to fall. On the other hand, if there's competition among buyers, that will make it so that prices will tend to increase, and only those households or consumers who have the highest ability and willingness to pay will actually receive them, thus likely increasing profit margins to the suppliers. Let's talk about the economy and some general measures. The first of these is the Consumer Price Index. Each month, the U.S. Bureau of Labor Statistics contacts businesses to get the prices of about 80,000 items. These items are then combined into a market basket that is proportional to the typical household consumption patterns. The price of that final market basket is then calculated and computed into an index that is reported. With this index, we can compute the inflation rate in the United States. Another measure is gross domestic product. Gross domestic product is the value of all final goods and services produced in one calendar year that are purchased by consumer, business, and government entities. The total economy includes interactions between the monetary economy, which includes all financial transactions in stocks, bonds, money markets, etc., and the real economy, which includes transactions in production and sales of goods and services. Let's take a moment and talk about the banking system. The banking system is controlled and regulated by the Federal Reserve Bank of the United States of America. The twofold purpose of the Federal Reserve is to, number one, keep prices stable so that consumers and businesses are confident in their financial futures, and number two, to keep unemployment levels at acceptable and stable rates. One of the primary tools of the Federal Reserve Bank is the management of interest rates. The Federal Reserve directly manages the money supply through open market operations. Managing the money supply changes the interest rates in both short-term and long-term markets to some degree. To stimulate growth in the economy, the Fed attempts to lower interest rates. To control inflation, the Fed desires to increase interest rates. The extent to which the Federal Reserve is successful in either raising or lowering interest rates depends upon the expectations and actions of businesses, households, and of course, banks themselves. Let's talk about banks for a moment. A bank is a business that receives deposits, makes loans, and provides other money-related services in order to earn a profit for their shareholders. Depositors put money in banks to earn interest and have their deposits secure for later use. Borrowers seek to borrow money by promising to repay the money plus interest. Interest rates depend upon the risk of the project, the borrower credibility, general money supply versus demand, and general economic conditions at that point in time. So banks help depositors meet their financial goals. There is a difference, however, between saving and investing money that it's important to point out, and banks help with both of these activities. Saving money means securing those funds in banks and keeping it safe from the probability of theft, destruction, or loss for interest-earning gains. Investing money, however, is purchasing an ownership or a lender position in a company intending to grow it for future use, but exposing those funds then to the risks associated with the market and the performance of the business. Both saving and investing are important for depositors in banks. So let's talk about risks and how interest rates are priced for a particular loan. The risk assessment of a particular borrower depends upon their individual or company's net worth, which is a function of the assets, budgets, liabilities, etc. So let's go through these. Assets. Assets are those items which a person or a company owns, including cash, savings, property, etc. A liability is what a person or company owes in the forms of bills, IOUs, notes outstanding, etc. Net worth is an estimate of financial wealth. It is equal to assets minus liabilities. A budget is a financial plan showing estimated income versus expenses, and sometimes it's referred to as a pro forma financial analysis. Taxes are those proportions of gross income or net income that must be paid to governments. Let's talk about how the kind of loan that you may want to borrow affects the interest rates. There are basically two kinds of loans. There are secured loans and unsecured loans. A secured loan is backed by the purchased item itself or other personal property which acts as the collateral for that loan. If the borrower fails to repay or defaults on the loan, the property that stands as collateral is repossessed by the lending entity and then sold to cover the remaining debt owed. An unsecured loan, or sometimes called a signature loan, has a higher rate of interest because they're backed only by a borrower's promise to pay. So let's talk about the things that you can do in order to better manage the interest rates that you end up being charged as you borrow money. Managing your interest rate is the same thing as managing your credit rating. And the credit rating is managed by, you got it, 3 C's of credit: character, capital, and capacity. The character of the individual includes their income, their ability, and their pattern of history of paying their bills on time. It's their educational background, the knowledge, skills, and abilities that they bring to their business, etc. The capital of the borrower is how much money do you have saved What are the assets that you have? New businesses are often short on capital and long on character. The third C is, of course, capacity. It's how much you have in cash flow to pay your interest payments. It includes then measures of debt to income ratios, interest coverage ratios, times interest earning ratios, etc. So these measures get at the question of how able are you to pay back the loan. So if you have good credit, you pay your bills, you can get a lower interest rate. If you have bad credit, you have a pattern probably of late payments, paying too little, exceeding your credit limits, etc., and you're going to pay a higher interest rate, sometimes more than double the interest rate, which then greatly increases the cost of the loan. So remember that credit is given to those who demonstrate the ability to manage money and make good decisions. So the credit reporting process occurs as you take out a debt contract and then the lending entity reports your performance to the reporting agency. So credit reports include typically information about you, your identification and employment data, all public record information, collection agency information, credit history, payment history, the number of inquiries related to your attempts to establish new open lines of credit, whether or not there has been bankruptcies or other judgments, criminal convictions that have no time limit. Your credit report determines if your company will be able to secure debt at a reasonable interest rate or not. It is important that you make sure that all the information on the credit report is accurate and timely, and that if it is not, it is up to you to challenge it. So in summary, the credit score that you have determines the interest rates that you pay. Your credit score is influenced by the total amount of outstanding debt that you have related to your income, whether or not you are prompt in paying your bills, percentage of available credit line that is used, the percentage of your total debt that is paid off, and your pattern of paying those off, either on time or before, and the length of your credit history. Regular monitoring of credit scores is important because mistakes can and are made, and it is up to you to take the initiative to make corrections when they happen. Thank you very much for watching this video. This video is brought to you by Credit Grid, your source for business credit knowledge.